Hello everyone, today is January 3rd and this is our first session of the Wyckoff Trading course, part 1, the analysis. I'm really excited. Every news cycle is new beginning, new people that come to our universe, and we start conversing, we start talking about the markets, about the analysis, how we read the charts. So hopefully for those of you who are new to our Wyckoff community, you will receive some kind of value from today's class. That's number one. Secondly, maybe some questions will be answered for you. That's number two. And thirdly, and more importantly, hopefully you will see the value in this education and you will join us for the duration of the spring semester. We have a payment plan of the 3 recurrent payments of $333, which is kind of popular lately. So I would just suggest for those of you who are planning to sign up, to go for that option. But you could most definitely pay for the whole course for all of the 15 sessions right away. All of our sessions will be about 2.5 hours, but I have a tendency to mismanage time. So in a lot of cases, we actually go 2 hours and 45 minutes. Sometimes even longer than that. This is just because there is a lot of material in 15 sessions that I give you. Also, on the top of just the knowledge and the material, I give you some of the exercises. We discuss the homeworks. So it just takes some time. And for those of you who are alumni of the WTC1 course from previous semesters and you're planning on taking this course, welcome back. And I'm really looking forward to working with you. All right, so for new students, the most important message for now, for today's session, is about the homework submissions. You will have homeworks. Almost each class will have some kind of homework, whether this is going to be a reading material or whether this is going to be something that you will need to do with the chart, where I'm going to give you a chart and you will have to label it, you will have to do your analysis and then submit it via email to me so that I would look at that. We will do the homework reviews almost in each class. So all of your questions that you have either will be answered in the next class, in the homework review, or sometimes, very rarely, if the question is not that big, I could answer that question in the email. Now, the most important part about the homework is not even your analysis, but the way how you submit it. I really, really would like to insist that you submit it in one file only, whether this is a PowerPoint, PDF, or the Word doc format. And I also would like you to state in the title of the email the class, because we have quite a few classes, and the number for the homework. And then send it to our address, wyckoffAssociates@gmail.com. Now, our classes are interactive classes, and we will go in February into what I call a systematic exercise, where we are discussing the chart in the class together. And someone from the class is analyzing the chart, and I'm giving my live feedback to this analysis. So for that type of interaction, please make sure that you have a headset with the built-in microphone. And we usually have two types of students: observers and students that participate a lot in the class. So obviously, if you're an observer, you don't have to think about the microphone. You could just be there, be present for live sessions, watch the classes as a recording. And then for those of you who will be participating actively, then make sure that you have the headset with the built-in microphone. All of the recordings and slides will be only made available to paid students. So make sure that if you're going to join us today, join us tomorrow, join us during this week, but join us sooner than later, because with the homeworks, as they're gonna pile up, you're gonna have quite a lot of things to do, and quite a lot of things on your hands. There is a question about the access to the recorded sessions from Jerry. So this particular session will be recorded, and it is recorded right now. It will be posted on our Wyckoff Trading Method YouTube channel tonight, probably 2 or 3 hours after the class is done. And then for those of you who are students already in this class, we will be sending out the details or access details tonight as well. So you will have the access to the class page where you will find all of the videos as they become available after each class, all of the slides, and all of the homework slides. And then from that, you will be able to download homework slides and send those to me once you're done. All right, as usual, everything that we discuss in these classes is for educational purposes. Only stop your recording and read the disclaimer in full. So what is the curriculum for WTC Part 1? Quite a lot to cover. So we're starting with the market structural analysis. And I kind of always explain to our students why we start there. My preference actually would be to start with the price and volume analysis, or supply and demand analysis. But we can't really discuss price and volume without understanding how the price structure develops in the market. How do we go from one environment, price structural environment, to another? What do we have in between? So for instance, changes of character between the trends and consolidations. Where do they occur? How do they occur? What are the characteristics of those? What kind of trading decisions we could make there, and so on and so forth. And then as we go into the consolidations, the Wyckoff events and Wyckoff phases analysis becomes extremely important. So for the first 5-6 sessions, we are actively studying market structural analysis. And probably one of the mistakes that I see with students is just to start labeling right away the trading range, because this is like the first urge that we as Wyckoff and traders analysts have when we look at the trading ranges. I tend to go away from this lately and insist upon analyzing the bias of the trading range first. Once you know the bias, then we could put the correct labeling. And we'll talk about this. But again, we will start with the market structural analysis, which from an educational point of view makes more sense. Sessions number 6 to 10 on supply and demand or price volume analysis. This is a very, very crucial piece of information in our analysis. And the majority of the time we're going to spend on the law of effort versus result. Effort, which is being represented by the volume signature, and result, which is represented by the price movement. We will do and we will go through the volume spread analysis or bar by bar analysis. We will also look into the swing by swing analysis of price and volume. We will look at the volume patterns in different Wyckoff phases, also a very important piece of information for us to decipher on the bias of the trading ranges. And then we'll bring out some historical analogs as we go through the systematic exercise through which so many students actually went through. And that would conclude the first two most important big modules of the WTC 1 Part 1 course, market structural analysis and the price and volume analysis. After that, we're going to cover in 2 sessions relative and comparative analysis. And this is probably going to be more of the introduction to intermediate level type of knowledge. And I know that a lot of you guys already know what it's all about, but I like the basics. I like to stick to basics. And even though you might think that you know, you might miss something. So I want to make sure that we understand how we go about filtering and scanning based on the relative and comparative analysis, and how do we identify that institutional signature of accumulation and distribution through relative analysis. I also will give you some proprietary things that I've developed myself, a sweet spot of the outperformance as the predictor of the short-term price behavior. And then we'll talk about filtering and scanning, what kind of tools we have. And I'll mention different websites, different sources that we use, and different ways of going about the routine of filtering. After that, we'll concentrate our attention on trade management. So here we will talk about the points of entry, points of exit, stop losses, their placement, their movements. How do we scale in and how do we scale out of positions? And again, this is probably going to be more or less introductory to intermediate type of level knowledge. But it's very crucial that, again, we establish the proper tactics as to how do we go about executing our analysis and ideas that we have found through filtering and scanning. And then the last session, session number 15, as usual, is going to be a Q&A session. So this is one of the students' favorites. We usually accumulate questions by that time. And with that, a lot of the questions that might not have been answered during the semester will be answered. It's a lot of questions in one session usually, and for 2.5 hours, it's just kind of like a very interesting session. Okay, what else do we got? For those of you who are interested in more advanced knowledge, and I would say that the current course, WTC1, Wyckoff Trading Course, Part 1, actually has a lot of advanced elements. But for those of you who are more interested in the skill building of Wyckoff concepts, you will still have to take WTC1 as the prerequisite. We just have tried multiple times, and I had students that came to me and they said, well, I've studied with this person, I've taken this course, I've read this book, and multiple times when I inserted students like that into the next level course, they just were not up to par with our material. And once we place them back into WTC1 course, there is a very rapid recognition that they needed that. So I would urge everybody, who's thinking like, okay, well, I'm just going to go for the advanced level, to start with Part 1 rather than, start thinking about right away Part 2. So what do we do here? Well, first of all, tomorrow is a free session at 3 p.m. Pacific. Open door as we are conducting this session right now. And the curriculum is definitely more in-depth than WTC1, where we are applying the knowledge that we have gained in WTC1. And our primary focus is on drills and exercises. And if you attend tomorrow's class, or you just sign up for the webinar, and then you will receive from us after the class a link to the video, you could do that. You could see how we go about the drills and exercises. It's extremely important to me personally as a teacher of many years, more than 10 years plus of this material, to not only give you the knowledge, but also to push you into the exercise mode. Because I always tell my students that knowledge does not equate to skill. If you have knowledge, and we have tendencies as traders, when we fail with our trades, to go and to seek more knowledge. And then we start hoarding that knowledge. And just being a teacher, I see this over and over and over again, and I've done it myself. as I've been, a student myself 20 some years ago. This is not necessarily the way to succeed in trading. You definitely could become more knowledgeable, but you will not be skillful. And this is where a lot of the problems for a lot of the traders arise. So just consider that, even if you're not going to take our classes. I want to give you this idea, to put this in your head, to think about that knowledge, whatever knowledge you have, might be sufficient for you to develop the skills to be successful in trading. So WTC2 class, which we call the practicum, is all about that. It's just building the skills through rigorous exercises each week. And it's a lot of fun. I mean, we have students that are repeating this class, many times, 5, 7, 8 times already. Some of the students do this from semesters to semester because they recognize that building the skill is a necessity in our profession. We will concentrate on the bias and timing, but we also will develop a much better understanding for trading tactics and management. We will talk about different price structural scenarios as to what might happen, how would we behave in those situations. The mental preparation based on your analysis is extremely important, especially in some instances where we don't recognize the bias correctly or it's not visible to us with the information given. We'll talk about the trade management, the risk management, how do we select the candidates, and then we'll also talk about a lot of advanced Wyckoff material, whether those are specific, phase behavior or volume signatures in a specific spots, trend recognitions and trend analysis, and maybe, in a lot of cases, we talk about the modern TE tools and how those, in combination with Wyckoff concepts, could be applied. I also have been working on a body of knowledge for the practicum where we talk about probably, I would say, like volume spread analysis. I call this the significant bar analysis. So this is something proprietary that I've developed where we look at the specific bars and their significance to the whole construct of the price structure. And we've been pretty successful with students developing those concepts in the last 5 semesters. So the body of knowledge there is quite significant, and I'm very pleased with that. And we are at the point where there is a lot of mechanization of that knowledge. So for those of you who will be joining us in WTC1 and then will graduate into WTC2, this is going to be an interesting exercise. All right, today, we're going through the introduction right now. The homework for those of you who signed up or who's going to sign up is going to be to read Jim Forte's Anatomy of the Trading Range article. I consider this article the best article that has been written on the market structural analysis, Wyckoff structural analysis. Unfortunately, Jim has passed away unexpectedly, I believe, last year, and we've lost quite a few unbelievable Wyckoffians in the last 5 years. I mean, you think about Tom Williams, Hank Pruden. I would even put Dick Arms, because he was such a Wyckoffian at heart. Of course, David Weiss. That was, together with Hank, for me personally, Hank and David Weiss were just like such a huge loss. And then, the late Jim Fortes, who I was taking classes together at Golden Gate University back in the late 90s. It's just so many great people, Wyckoff people that just passed away. But, his article was the beginning of my path, together with the Golden Gate classes as well. And it's an extremely well-written article. So this is your homework, and we'll talk about this in a little bit. I'm going to give you my market update. And with the market update, this is something that we do each class and in each class that I do. So from Monday to Wednesday, we are in this constant market update. Those updates are for our students. We do place some of the short videos on Twitter with the market update from those classes, so you could catch those on our @Wyckoff Analysis Twitter handle. And usually we go through all of the major markets, including S&P, NASDAQ, Russell, the Dow, gold, Bitcoin, oil, maybe silver, maybe yields, depending on what we're looking at that time. After that, we'll go today into the initial introduction of the methodology. We'll talk about Richard D. Wyckoff himself. We'll talk about the heuristic concept of the composite operator, which is extremely important for our method. And then, again, a very important concept of the price cycle. And we'll talk about, what could we expect from the price movement and what are the behaviors of institutions at different price cycle spots. Then we'll talk about the behavioral market analysis and we'll identify who are the market participants and what are their characteristics and therefore behaviors based on those characteristics during the price cycle. And we'll talk about those from the point of view of the case study. In this case, we're going to study Apple charts. Next session is going to be on the price cycle and different elements of the price cycle. We'll talk about the change of character that leads either to accumulation, distribution, reaccumulation, or redistribution. And unlikely that we will go into the phase analysis, but sometimes it coincides, so we might talk about the phase analysis as well. If not, then session number 3 will be devoted to this. And homework number 2 is going to be your first homework with charts. So today's homework is on reading, and I just want you, to read Jim's article, make notes, and so on and so forth. The next homework, I'm going to give you charts, and you will have to label those, and we will review them in the next class. All right. A question from Siddharth, and I'm sorry if I mispronounce your names, guys. How long after completing WTC1 should I sign up for WTC2, or should we be taking both side by side? Definitely not side by side. So I already explained why I'm against that. There is no reason for you, there is no educational reason for you to do that. There is so much material in WTC1 course. You basically will be spending a lot of time rewatching the sessions, making notes, doing the homeworks, and just analyzing everything that we do. So you could sign up right away for WTC2 class, whether it's a live class or whether it's online class, or alternatively, some of the students come back to WTC1 just because there is a lot of material. The expression that students have for that is drinking from a fire hose. That's very true. You just have to observe a lot. And sometimes it's valuable to repeat the course as an alumni. Suleiman, I'm not sure I understand the question. Could you rephrase, please? Okay, so here is this article. I'm going to post this article on the class page for all of the students, or for those of you who's going to sign up. You could find this article on our website. It's free. For those of you who are not going to take the class, I would highly recommend reading that article. And that's a mandatory assignment for our students for next class. So make sure that you read the article. Also, for those of you who are new to Wyckoff Analytics, check out on our website a free newsletter that comes out on Sundays. In this newsletter, we give you the market update. We give you the latest content that we create, whether those are videos or any kind of blogs or bias games and so on and so forth. It's free, and it's just only once a week. We don't bother you during any other days. You could also go to our YouTube channel, and I know that a lot of you found us from the YouTube channel. We've got quite a lot of videos there. Those are either majority of those are legacy videos, but some of them are market updates, so you could have both. And then obviously Twitter is also another way to communicate with us and see what is in the works, what is coming up, what kind of analysis we're pushing to our social media, posting it there for your view. And usually during the semester, we kind of have the analysis almost each day that comes out to any type of social media platforms. All right, well, let's start with the market update. We are 326. All right, so what do you guys think? Let me just have a pop quiz here for you guys. Where are we with the trends? Let's just take S&P 500. This is S&P futures. What is the trend right now? Please write it down in the questions box. Okay, and majority of you are saying uptrend, bullish, uptrend, up. Okay, so I think that we should quickly state, or you know, a more appropriate answer probably also would be a question to me. Well, what do you mean by the trend? Which time frame, right? What is the time frame of the trend that we're discussing? So we usually go with the long-term, intermediate, and short-term. So long-term uptrend, I would be thinking that this is an uptrend of 2009 low, because this was the secular low that we have had. Since then, we're still in the uptrend. Let me just show you that. Okay, so here is this low right here. This is a very significant secular low. You could make an argument that the COVID also was a significant secular low, but I would say that there is a cyclical low here as well. So we're still pretty much in this ongoing uptrend since 2009 low. What is our intermediate? Let me just erase this. What is our intermediate trend? And I would say that there are two components here to the trend. So here is one phase of the uptrend, and we are currently in the second phase of the uptrend. So we're seeing here what? High highs, high lows, a definition, conventional technical analysis definition of the uptrend. So therefore, long-term trend is still up, intermediate trend is still up. And then now to the short-term trend. What would you say about the short-term trend? And we could consider even this area right here to be an intermediate trend. So we'll talk about this in a second. Okay, trend and range. People are saying, yes, I would be thinking that if our time frame for intermediate trend is going to be somewhat of a several months type of trending environment, then we could say that we are still currently in some kind of trading range. And then the short-term trend will be the last swing, which is currently to the upside. So we could say something like this: long-term trend is up, intermediate trading range, and then a short-term trend is up as well as the last swing up. We could also, if we are considering that intermediate trend is more of the trend since the COVID low, then it's going to be up as well. Okay, so great. Thank you guys for that. So now let's go and analyze a little bit the swings and the bars that we have. Now, the very much big attention for us today was the S&P specifically is this bar right here. This is a breakout bar, which actually overcomes all of the points of the resistance that we have had in this structure. And the NASDAQ, Russell, and the Dow are somewhat different structurally. So please keep this in mind that we are only talking about the S&P right now. So this is somewhat of an important bar for us to observe. The key here for us for the continuation of the upswing is going to be an ability of the current test, we are currently testing this bar, to hold here, to hold and not go anywhere back into the trading range. And with that holding pattern to exhibit some absorption characteristics, where maybe some supply is coming in, like there was somewhat a little bit of the supply that came today, even though it was an up bar, we don't commit above the resistance. So that shows us some kind of presence of the supply that does not allow the price to go up freely. So when supply occurs like this, we want more testing and we want more absorption. So therefore, trading range characteristics to expand to the right, and then a breakout as a confirmation of the continuation. So that would be a very simple bullish type of the scenario. The bearish scenario is going to be, again, all related to this bar. Would we be able to first break one level, break the second level, and then come back into the area of the much larger trading range? If this would be the case, then we would say that this rally, which happened on the diminishing demand signature, and obviously we have to keep in mind that this diminishing demand signature is happening also because of the holidays. But nevertheless, if there is a failure to continue, and if the price will start to come back, and it will become very evident very soon, because we have attempts to break, and the first break is successful. Today was another attempt to do so, and we failed to break out. And that's what's so concerning. If tomorrow's bar is going to be a negation of today's price action to the upside, this could become somewhat problematic. And if we start breaking those levels, level number 2 and level number 2, 1 and 2, then this could become an upthrust. So to me, as I look at this picture, I say that let's just wait. Let's just wait for a couple of days and see how the beginning of the year is going to start unfolding. And whatever scenario is going to present it to us, we could always construct the trades just based on those scenarios. We could always filter out some candidates to the upside and to the downside. But it's extremely important for us to define where the market is in terms of the bias. Okay, let's go to NASDAQ. NASDAQ has also a trading range structure on the intermediate short-term basis. And here we're seeing some of the elements of the weakness where let's say, the price forms lower lows after the change of behavior. And we're seeing a lot of volatility in general with the price spread expanding, especially to the downside, with a lot of volume signature expansion, which suggests presence of the supply. So there was quite a lot of selling here, and we have quite a lot of catalysts, for this selling going into the end of 2021. Omicron, inflation, Fed. So those are kind of like the major things to consider. Again, here, as we are looking at the structure, what do we observe? We're seeing that the attempt to rally that we've seen more successful being in the S&P is actually not that successful. We are forming a lower high, and the attempt to break out happens above the buying climax line, the stop in action, initial stop in action, but we don't really overcome the subsequent upthrust that NASDAQ has had. And more importantly, the current test in the S&P is still within the body of the last breakout bar. For NASDAQ, we are already testing the lows of this bar. So that again shows some weakness. And this weakness happens on diminishing volume character, which suggests some kind of ease of movement to the downside. Now, today's bar was important because this is where we need to find the support. This is where we need to find demand coming in. And it does. It does come in and it pushes the price up. Now, how would we measure the progress of the price today? We would be comparing it to the previous 4 bars on the upside, and we could see that this is not the best progress that we have seen. But still, it's a bullish day. So again, what we want to see in the bullish scenario is an ability of the price either continue to the upside right away or staying in this kind of like testing mode until there is a subsequent breakout, which acts as a confirmation. Or for the bearish scenario, we need to see an inability to continue. So if, let's say, tomorrow we have some kind of negation of the previous bar, or maybe tomorrow we have a continuation, but it's still mediocre, and the spread diminishes, and then the price starts to reverse down, and this level is broken, the level of the low of the last significant bar, breakout bar, and the level of the more recent support that was formed in the last day of the 2021 and the first day of 2022. If we break that and we come back into the structure, then volatility most definitely will increase again. So kind of an interesting spot. And my suggestion here is just to wait a little bit and see what kind of scenario is going to unfold. Okay, Russell, which was so much fun to analyze during the whole trading range, and we've kind of identified this low, this low, this low as an element of the reaccumulation structure. So we caught the getting out of the formation and getting out of the structure. And after this bar, which was the most important bar at that time, and it still stands as the most important bar right now. This is where we've changed our bias to back to the trading range. And we've identified this reaction as a change of behavior. So the change of behavior comes after the reaccumulation environment has been established. And from after the change of behavior, we have to see the ability of the price to overcome this very significant bar. So overcoming at least 1/2 of that bar would be great. So having a continuation to the upside with the commitment to the upside would be very much important. And overcoming the high of this bar is going to be extremely important as well. Now for the bearish scenario here, and we are the current background is still to the downside, and a trading range which goes nowhere and which doesn't attack the high or the second, the highest 1/2 of this big bar, that would be the scenario for the bears, to look forward to. And obviously, we would have to see some kind of further deterioration within the trading range where we have the reaction that maybe makes another lower low, attacks this support, comes back with even lesser rally, and then after that drops. So this is the type of the structure that I would be thinking if I would be a bear here. Again, I think as with other indices, especially at the beginning of the new year, we have to wait and just to see how the first buying attempt is unfolding. So far, I'm not that impressed with buying, even though buying comes in, even though we see the demand here. The background is still to the downside. And to negate this background, again, we need to see some kind of very, very aggressive buying on a lot of volume expansion and a lot of expansion of the result. All right, let's go to Bitcoin, because I know that you guys are probably very interested in this. So what I've done with Bitcoin, my current trade with Bitcoin, was identifying this area right here as an accumulation at that time and entering my position here on this bar. So this was a great bar because it just shows a lot of momentum to the upside on increased demand signature after we are producing an attempt to spring. The spring is the Wyckoff term. We'll study that in our classes ahead. And then looking at the rally, how that develops, rally by the character and by the result confirms that we are in the accumulation structure. My second add-on was here around 45,000, which was not perfectly timed, but still the confirmation came relatively quick after that with, again, the same type of signature where the momentum increases, demand is increasing and pushing the price up, so result is increasing relatively quick. And I actually have closed the majority of the position right here. So here's my point of exit number one. Here's point of entry number one, point of entry number two. So what was the reason here to scale out significantly? Well, first of all, the stride of the trend has been established, and the price actually shows that this stride is correct. So this was a very significant moment if the price were to break that stride. If the price were to break this stride, we definitely would revisit at least this target area right here, which we did. So that was just a trade management where you significantly diminish your position. But if you're a long-term investor, I definitely see the argument for holding on to the position as well, maybe scaling out some. But if you do that, you definitely want to scale out more in the overbought conditions rather than on the break to the downside. So what do we see currently? The current structure is a trading range as well, with this expanded boundaries right here. And I wouldn't be saying that the rallies are of a good quality. All of the rallies that we have seen since the stop in action, the climactic action, are somewhat mediocre. They do not have a big effort behind them and a big result behind them. So the first automatic rally that we see does not even come to the high of that capitulation bar. In the original accumulation, we had that. We had the price come and retest the high of that bar. So that was a very significant clue in phase A at the beginning of the trading range to assess how strong the buyers were at the point of the capitulation. And then all of the subsequent rallies are not that great either. And the best rally that we see fails almost instantly, right? So we are staying here trying to produce a good test, and then on the expanding supply signature, the price starts to drop down. And we are at the support now. And the latest attempts to rally here are not that great either. So I would say that character of the current trading range is still weak. It doesn't mean that we might not rally. We could rally here. I still think that we would rally in the context of the trading range that we have here. And the bulls really need to prove themselves first. We need to see some kind of change of behavior where the rally is not only going to come to the resistance, but overcome it in some way. And then retest into a higher low and then continue to the upside. So that would be that bullish scenario that we're all looking for. The bearish scenario is just a continuation because you already have the background to the downside, so that is established. And your continuation is just to break to the downside. In this case, if we break to the downside, what's the next target? Well, everything that we've seen before at the lower prices. So 30,000, if we break to the downside, is quite possible. And then we will be talking about this kind of like this big, huge structure. So we'll talk about it if it happens. All right. Let's look at gold, which is also extremely interesting. And throughout the last 2 semesters, this whole 2021 has been such a amazingly interesting short-term picture in the context of the long-term uptrend since 2018-19. And we called this chart an enigma multiple times. We definitely see quite a lot of selling off the top, then into different breakdowns, and we're seeing how selling is so aggressive. It's the price spread in the increase in the volume signature that defines that aggression. And as we see in this selling, the selling becomes selling at the lower levels, right? So there's some kind of stepping stone to the downside selling that we see. Now, what's encouraging for the bulls are different elements of the structure. If we're seeing that the first 2 legs to the downside have very significant selling and the price follows that, then the third reaction actually stops at the support level, and not only that, supply signature on the capitulation in both cases here, 1 and 2, actually starts to diminish relative to the prior aggressive selling. That's number one. So we're defining the character of the selling as less aggressive. Secondly, in terms of the result to the downside diminishes as well because we don't commit below the support like we've done before. And thirdly, the recovery on the capitulation bar itself with the demand tail, or the continuation that follows, or the next test that comes as a higher low is quite bullish. So we were commenting on gold that we're going to have the rally here, and potentially we could have a breakout right here. And unfortunately, the breakout did not happen. We saw a local breakout, but we didn't see a global breakout. So for the third time here, we have stopped and we have reversed. But what's encouraging again is if we look at all of the reactions that are happening, we're seeing diminishing power of selling to produce larger reactions, which is somewhat of a good sign for bulls. And if the latest reaction is going to be just what we have had today, just one bar to the downside, and it stops somewhere in this area as a high or low stopping point, and then maybe consolidates here and starts to grind through the resistance, that could become a very, very bullish sign. And I think this would start producing change of behavior type of rally. And this is where we could start participating in a more aggressive way, and not on the lower time frame, but on the high time frames as well. So gold is quite interesting. And for those of you who are going to be in this class, we will be discussing it each Monday. Okay, let's look at oil. Oil is interesting just because of the catalysts surrounding oil, where we have two opposing forces. We have the US increase of the supply of oil just because of the politics at the gas station. Current US government does not want the gas prices to go any higher, as it's going to influence not just consumers but also inflationary numbers. And oil is a huge factor of the inflation. So they want to contain the inflation even more, I think, than to listen to the consumers. And then on the opposing side is the OPEC, which is decreasing the availability of the demand, and that produces the pressure for the price to go up. So this is kind of like this macro game, which I call an oil war. And usually when we have such opposing forces, that would suggest some kind of consolidation, a trading range. And after, again, a very interesting change of behavior, I think this is where we are. And this is where we are going to be for quite some time, at least, the first portion of the 2022, this is where we are supposed to be. Here is the trading range defined by the most important bar right here. And I'm liking how the rally after the local test actually comes close to the high of that bar. So that suggests that the nature of this consolidation could still be bullish. But, we have to see whether we could break out to the higher boundary here, or whether we still going to consolidate somewhere in the trading range itself. And this type of event where we have a lot of supply increase and a lot of downward result that follows that increase, we definitely want to give some time where duration of the trading range might actually increase. So it's important to understand that the trading tactics that we would choose here probably going to be more short-term oriented at this point of time, until we see some elements of absorption of the supply that came, and that absorption might actually come through more consolidation. All right, well, I think that's it for our analysis. We'll discuss silver maybe in the next class, next Monday. So with that, let's continue with our class material. Let's talk about Richard D. Wyckoff himself. So who was he? I want to point your attention to a couple of sources on the biographical sources on Richard D. Wyckoff. And I want to recognize Stella Osoba for her contribution to our community on the life of Richard D. Wyckoff. She had a 5-part article in the Stocks and Commodities magazine on the life of Richard D. Wyckoff, and we reached out to Stella and invited her to one of our Best of Wyckoff conferences, which was in 2019, and she gave a wonderful talk on who Richard D. Wyckoff was and how he came, to be such a great analyst and educator. I would highly recommend reading the article. I would also highly recommend going to our website, and this material now is free. So you could go and actually explore all of the Best of Wyckoff conferences that we have had since, I believe, 2017. So accidentally, 2017 Best of Wyckoff conference was the last conference and last event that Hank Pruden attended and spoke at before his passing away. He passed away 1 week after that. So you could go to that presentation. He was talking about his P&F horizontal count calls on the market since 2009 low, which was, a series of highly accurate and fantastic calls. So check this out. We have those on our website as well. All right, so who was Richard D. Wyckoff? Well, as a lot of us, more than 100 years ago, he started studying the work of the markets when he was still young. He was working for different, market shops, even as an adolescent. And then he has become an editor of the magazine of Wall Street. And this is probably one of the most, significant developments in his life. This is where he had an access to a lot of big stock operators of his time, like, Jesse Livermore, with whom he conducted multiple interviews, Harriman, Keene, Morgan himself as well. So he had a very interesting vantage point into how stock operators of his time would conduct campaigns, where they would accumulate a certain supply of shares in the stock, and they would promote that stock through the price action, specifically through the uptrend. You know, this whole definition that we have for the uptrend, higher highs, higher lows, they would construct that with this series of buys and sells, or with the series of buys and inactivities where the price would just retreat back, and with the support of the price at the line of least resistance. So all of those principles, Richard E. Wyckoff has studied from those stock operators, and he codified that and put them into the original Wyckoff course, which came out after, right before his death in 1934. So the course that he has published was published, I believe, in 1931, 1932. It contained quite a lot of information. It is in the public domain, so I also would highly suggest for those of you who are advanced students, to read that course, but only after you study, more contemporary version of the Wyckoff methodology. To me, that material is somewhat outdated, and I would only read this with already somewhat of the understanding of the method. He also introduced to us an idea, a heuristic, which is the composite operator. We're going to come back to this, but let me just finish on Wyckoff himself. Before the Magazine of Wall Street, he had a publication which was called The Ticker. And I think that this is where his writing abilities, started to shine. He had, different interviews. This is 1909. December issue, and look who is he's interviewing here, William D. Gann. So it was kind of interesting how he had the access to what we consider the great grandfathers of technical analysis. Somebody like Dow himself, Edwards and McGee, Elliott, Gann, and so on and so forth. He published quite a few books. A lot of students ask me, should I read the books? Yes, you definitely should, but I think that the timing of when you read those books is important. Again, I would be inclined to push you towards reading modern adaptation first and then come into his books, because his books do not necessarily contain a systematic approach to the method, but a lot of like stories about how, either his life or his trading, or some principles like, tape reading and so on and so forth, which are not necessarily systematized. So you have to have some kind of understanding of the method before you do that. All right. So here is the front page of the original course by Wyckoff. Again, the copyright here is 31, 32, 33. He passed away in 34. Bob Evans, who was his apprentice at that time, has inherited the company, the Wyckoff Associates, and then from there, Bob Evans was able to develop new concepts, which we're so grateful for. A concept of spring was now a Wyckoff concept. A concept of phase analysis was now a Wyckoff concept. So there are quite a few concepts that were not developed by Wyckoff himself, but by the people that follow in his footprints. And we are definitely grateful to Wyckoff himself and all of those who followed him. All right, so what is the composite operator? What is this heuristic that we keep talking about? Wyckoff published an article that he wrote himself in the Magazine of Wall Street on who the composite man is. And I want to bring your attention to one paragraph, because originally when I was taught this methodology back in the late 90s, I was taught that the composite man is predominantly an institutional entity. And there is a lot of truth to that, but that's not accurate. The composite man, as I understood studying the methodology, does not necessarily mean that institutions will be correct always. There are a lot of institutions, and there are a lot of institutions that are on the wrong side of the trade. So those are not acting as the composite man or the composite operator in the specific position where they are going against the price cycle. So therefore, we will consider those institutions in those positions being weak hands. So someone who is well known, like for instance Warren Buffett, usually would be considered a composite man, and rightfully so. I mean, the record speaks for it for that. But at the same time, Warren Buffett has made quite a few mistakes that did not derail his, career, but that he recognizes. One of the latest mistakes that I remember him discussing was in IBM, where he entered the position and then he had to give it up, and it became a very big trading range. So in that particular position, Warren Buffett was not on the correct side, so therefore was not acting as a composite man. And then I have found this article where I have found the confirmation by Richard D. Wyckoff himself that his understanding of this heuristic also has developed, which was very pleasant for me to see that we were kind of like thinking in the same way. So let's just see what he wrote here. Who is the composite man and where can he be found? He consists of some 2 million personalities scattered around the face of the earth. So at that time, this is probably like the number of traders that were trading just in general. Some of his component parts are richer, more powerful than others. So obviously institutional types, and obviously institutions of that era. Some are noted for their foresight, intuition, shrewdness, conservatism. So this is probably analysts and probably some kind of, professional traders. Some for dash and daring, reckless quality of their moves. So this is probably speculators. These millions of personalities form one omniscient who stays the market, crushing those who do not know and who will not learn how to benefit by him, and crowning with profit and income those who do. So as you could see, the composite operator is not necessarily just one type of institutional entity. It could be different type of market participants that would participate in the price cycle on the correct side of the trade. And we as retail traders could be a composite operator as well, not necessarily with the size, which we will never have that. But as a retail trader, you could always be on the correct side of the trade and on the correct side of the price cycle. Then you could say that you are strong hands because you were participating in the correct on the correct side of the trade. And later on, Wyckoff would call this the smart money that manipulates the stocks to your disadvantage. And I think when people ask me, or they come to me and they say like, well, the composite operator got me out of my position and it hit my stop loss. This is such an incorrect way of thinking about your stop losses and the way how your stop losses were triggered, or for what reason they were triggered. My usual kind of like follow-up question for those of you who think that you are being almost followed by the composite operator is the question of what is your size? How many shares do you trade in a single position? And the usual answer is somewhere between 100 shares to several thousand shares. And would that be of interest to the composite operator, the size that you have, to chase and to trap you? Most definitely no. And if you think that they still kind of, after you, I think you give yourself a little bit too much credit. So just think about that as a thought. Most likely, if your stop loss is triggered, this means that your analysis defined incorrectly the bias, or your stop loss was placed in the incorrect place. Because if you place the stop loss where below the areas of where institutions have produced a major buying, they should not be triggered. Because if the price comes back to that level, the institutions will start buying again. Because the price comes to the value zone for them, and they will continue their buying program. All right, well, we'll talk about the composite operator more during subsequent classes. Speaking of the bias and speaking of the skill building, we have on our website and also on Twitter a game which we call a bias game. This is where we give you, and this is completely free, we give you some kind of trading range to consider. So here's the trading range. And we ask you a question: what do you think the bias is for this trading range, accumulation or distribution? And we post it on Twitter as a game. So the first an assignment slide comes out. You could vote on what you think the bias is, and you could see the social media bias behind people's analysis. And then several days later, we publish the solution with our labeling, with our Wyckoff story, which is extremely educational. And you have to read through this sentence by sentence, make notes, and identify what is it that you don't see in this chart that we're identifying, as the potential point of interest to us. You could also come to our Wyckoff Analytics website, and all of the bias games are, you could find on the bias game page, and you could go through them one by one. In fact, our WTC2 students, the practicum students, analyze, upcoming bias games, and then we discuss them in details during our practicum classes. So each WTC2 class has some kind of post analysis of the bias game. All right, so let's talk about some of the objectives for our price structural analysis. This is where we start our analysis, this is where we go into the price cycle. We obviously want to understand how we make the observations about the market participants' behaviors on the chart. I think this is the most important element of chart reading, not just seeing the bars, but understanding what's the intention behind those. Who is acting out on the specific bars, especially in the moments where liquidity is pretty high? And what is the result of that behavior? Once we do that, we could make some kind of conclusions or deductions about the intentions by market participants. So for instance, if we have some kind of stopping action, which is being driven by the weak hands capitulation, and then we see the stopping action as the climactic stopping action, we would recognize that institutions are actually coming in with some demand, and that's why the price stops going down. And that's why the price might start producing some kind of rally, which we would consider a change of behavior rally. And then from that, we would deduce that the next environment is going to be a trading range. And from there, we will go into our phase analysis. And we will look for the bias characteristics. We will look for the timing of the price getting out of the trading range. And we also will look for the character of the next move. This will come as an important subject for us in our analysis as we would conclude our first initial module on price structural analysis. And then the next task for us is just to trade alongside the smart money. So look at the chart, decipher what different market participants are doing in this moment, deduce what kind of bias this trading structure could have, identify the timing of when we need to participate, and also select your participation in a specific stock or in a specific crypto or coin or in the specific futures based on what kind of possible character of the next move we're going to have. So where do we start our analysis? We're starting with the understanding of the price cycle itself, and we're going to cover it today. We also, as I mentioned before, are going to study the behavioral market analysis, which we're going to cover today as well. Trend analysis, the way how the price travels after the initial, initial consolidation. And changes of behavior versus changes of character are also very important. This is just the development of the trading range itself. That's number one, and the transition points between trending and non-trending environments. And then, also we will cover the attributes of the accumulation and the distribution based on the schematics. So schematics is something very popular right now in the Wyckoff community and beyond Wyckoff community. So this is how people kind of perceive our methodology. I would say that this is a wrongful impression, but if that gets you into the method, I don't mind that at all. All right, well, let's start with the price cycle. So here is a very simplistic depiction of the price cycle. 4 major areas for us to identify in the price cycle. An area of the accumulation. An area of the accumulation will be associated with the conclusion of the downtrend, and specifically capitulation by weak hands. This capitulation by weak hands usually is very aggressive, because at this point weak hands emotionally cannot sustain being in the position and they want to get out at any cost. And that produces a lot of momentum to the downside. That increases selling pressure, increases supply, and that increases liquidity. That is a necessary event for the big operators, for the composite operator, to have in order for them to start initiating a significant, sizable position in a stock. Another element that the CO6 is value. So the price needs to drop, and it needs to drop to the area where the composite operator would consider there is a lot of value for them to start accumulating this position. So liquidity and value are the 2 events that need to happen for the CO to start accumulating the position. And what that does, it increases the demand presence, which stops the downtrend and produces the rally of the different quality that we've seen in the downtrend. And we call this rally a change of behavior. And with that change of behavior, there is a suggestion that now we're going to go into the trading range, which is basically a testing of the presence of the composite operator. And through the testing, we go through different type of phases, and we'll study those. And the trading range develops, and the phases develop, and into the end of the accumulation, we're going to have the phases that are going to identify the emergence of the new trend, in this case, the uptrend. This emergence of the uptrend in itself a change of behavior. So if the price previously behaved in a certain way in the consolidation, now it starts to behave in a different way. So what we're studying in our course is that change, the trigger to the change in the environment from a trading range to a trending environment. In this case, this is an uptrend. Sometimes an uptrend is going to be called a markup. So this is a Wyckoff way of identifying, and calling the trend. But markup is just an uptrend, and we could use this interchangeably. During the markup phase, we are going to have pauses, and we are going to have moments where the price will kind of accelerate its advance and go into the overbought condition, react into the oversold condition, recover, go back, consolidate, and stay in some kind of what we're going to call a reaccumulation stepping stone type of trading ranges. And we will study those. We will study the elements of how those conditions are being formed, because those are going to become very tactical places for us to scale out and scale back in. And reaccumulations are going to have specific structures that we also will study. And as we approach the area of the overvalue, we are starting to see that the composite operator, which we could call also the value contrarian operator, because they come at the point of the extreme value with the extremely contrarian point of view on this asset, and they start buying it when everybody is having a bearish sentiment. They are doing the same at the conclusion of the up campaign, of the accumulation campaign, where they are the ones that are based on their contrarian opinion are starting to sell and distribute the stock. So with that, what that produces is some kind of stopping action that later on produces a reaction, which we will identify as the change of behavior. That is suggestive of the trading range, which develops to the right and has some elements of weakness or selling, and therefore the bias changes from up to down. And from here, we are seeing in the later phases, phases C and D, the emergence of the downtrend. So it's a process, and I usually state to students that change takes time. They cannot sell the whole position right away just because the position size is so big. If they would sell, that would tank the price significantly. They want to sell through the series of distributional steps where they sell and scale out, and that produces a change in the price behavior. And our goal is to understand how it looks on the chart, and then to develop the visual skill of recognition to actually see those type of changes. And once we see those, then we could start participating in the areas of where there is an emergence of the new trend. And that's our whole price cycle from the perspective of institutions or strong hands and weak hands. Let's go a little bit more into the details of this. And we're seeing here that the price cycle is still here, but now during the accumulation and distributional phases, we are during the non-trending environments, we're seeing that the trading ranges are divided into different phases: phase A, phase B, phase C, phase D, and then going into the uptrend, we have phase E. So what are those phases? And why do we care about them? Why do we actually care about the phase analysis? So Wyckoff has observed that during the consolidation, there is a repetition of specific behaviors by institutions or by the composite men, and therefore repetition of the behaviors by the weak hands as well, that leads to specific rallies and reactions, testing, up thrusts and sprints and so on and so forth to develop within the trading range. So if we know that, let's say, initial phase A is going to have the characteristics of the stop in action, then we know that there is going to be specific Wyckoff events like preliminary support as the first point of intelligent buying, selling climax as the stop in action, automatic rally as the change of behavior type of rally, and the secondary test as the local test of the sell-in after the sell-in climax. Then observing those Wyckoff events as they unfold live, we could figure out what phase we are in. And that allows us to identify the timing when we can open our position. That also allows us to think about the bias to a certain degree. Then in phase B, in phase C, we're going into the preparation mode where we are starting to get ready to advance into the new environment from the consolidation, let's say, to the uptrend. And then phase D and phase C is all about the change of behavior. Now the rallies are behaving in a different way that they behaved in the trading range. And the reaction also behaves in a different way compared to the previous reactions in the trading range. So studying those and studying the Wyckoff events that are associated with those phases, studying the characteristics of those events will help us identify the bias correctly, the phases correctly, and therefore the timing correctly, and would also allow us to understand the tactics behind the entering of the positions and how we would scale into, let's say like long-term positions as the emergence of the trend takes place. The same for the distribution. With the distribution, we're also going to have initial stop in action, and that would be associated with phase A. Preparation, where in phase B, we might have some sign of weaknesses, attempts to go above the resistance and then failure back into the trading range. Phase C is the last test of the demand at the resistance level. And then phase D, this is where a change of behavior takes place, and we see that the reactions now are much, much more than we've seen in the trading range, and the rallies are much, much less than we see in the trading range. Again, all of those are going to be labeled somehow, and we'll talk about the labeling a lot, especially in the next classes. We'll go through the labeling of accumulations and distributions, reaccumulations and redistributions, and that will allow us to understand not just the bias itself, but the timing as well. And then, of course, when we talk about the price cycle, we start with the simplistic models, and then we go to much more complex models. And throughout the whole price cycle, you might have multiple trading ranges that are going to have accumulation type of characteristics. And then through the downtrend, you might have multiple trading ranges that are distributional in nature. And studying those and studying how the bias has been either confirmed or failed, is extremely important for us. And in this case, what also is extremely important is just to understand the behavior of different market participants throughout the whole price cycle. So if the composite operator is going to be extremely active, let's say during the initial accumulation phase, and the composite operator might not be as active in the later parts of the trend at all. And that would kind of define the bell curve of the long-term volume signature that we might have. And that could point to maybe like one half of the current trend where the institutional participation starts to diminish just because they're already in this position and they don't need a much more sizable position at this time. And then that leads to the last speculative phase. We'll talk about this in the trend analysis, where the weekends are the major participants. So there are quite a lot of things for us to cover. Here's an example of a price cycle, a long-term price cycle, which doesn't even include, the current data beyond the 2020. So we're looking at Apple monthly chart, and we're looking at the very significant trading range that has started in 1987 with the departure of Steve Jobs, and then Steve Jobs comes back in 1996, I believe, and this is where the behavior starts to change. So this change of behavior is what we are after. We want to identify on the chart the presence of institutions based on the volume signature and how the price behaves, and then tactically to recognize what are going to be the points of entry for us. So let's say it's somewhere here, somewhere here, somewhere here, and on the way out, and so on and so forth. And within a much larger price cycle, so Apple still continues its uptrend up to this day, since the 1996-1997 low or 2003 low, if you consider that the low of the trading range where the uptrend has started. Within that big price cycle, we see smaller price cycles. We see the price cycle which is going to be very congruent with the timeframes and trading of a shorter term swing trader. So for instance, any type of swing trades that could be available, let's say, during specific segments of a much larger trend are going to be very significant to us. And they're going to originate from the areas of the reaccumulations, those stepping stone reaccumulation courses. So it's a fractal type of behavior where a much larger structure is going to have much smaller structures. And we will be studying this phenomenon as well. We also will talk a lot about the causality and the effect. So the cause, which is basically the buying or the selling, should produce the effect, which is basically a trending environment. And we could not only understand the bias and the timing of that causality, we also could understand the character, and with the character, we could measure potentially where that effect will bring the price, to which price level. And this is a little bit more advanced, so usually we discuss those in the PNF classes, which is the point and figure horizontal accounting, which is extremely unique to Wyckoff methodology. If you're not familiar with that, go to our website and read on that. All right, let's talk about the behavioral market analysis. So the definition that I gave to the behavioral market analysis is the studies of the market participants' behaviors in the context of the price structure. It is extremely important for us to understand who does what at the specific point of the price cycle. So for instance, when we talk about the final capitulation of the downtrend, the weak hands are going to be at the point of fear, so they're going to capitulate, and that's going to produce increase in volume signature. It's going to produce increase in the supply. That's going to increase the momentum to the downside, velocity to the downside. That's going to increase the downward spread as the distance between the high and the low. It could produce downward gaps. And those characteristics are going to define the climactic run, which will going to end up as a stopping action, as a selling climax. And it's extremely important for us to understand what the weak hands are doing in the relationship also to what the strong hands are doing. So if the weak hands are capitulating at that point, the psychology of the strong hands is to buy, because again, of those two things that I've already mentioned, there is a lot of value in the oversold condition, and there is a lot of liquidity because weak hands are giving up their position. So there is a lot of volume signature. Then at the emergence of the uptrend, we're going to see that weak hands are going to be exhausted through the trading range, as they're going to have losses first in the downtrend itself and then losses throughout the trading range. They will become most likely inactive. They will emotionally withdraw from trading this particular asset just because of the pain that has been brought to them through their trading of the downtrend and the trading range. And that allows other institutions that we will call our early institutional trend adopters or institutional trend followers start initiating the positions in the uptrend, and that will push the price to the upside. That will change the behavior from the trading range to the uptrend, and off we go into the markup phase of the uptrend. Then in the area of the overvalue, the strong hands are going to show the first signs of intelligent distribution. They will be selling into the strength of the uptrend. And you usually are going to see the bars that are expanding, and they're extremely bullish. And the volume signature shows us the volume spike. So whenever we have the volume spike, we will know that we have the expansion of both demand and supply at the same time. And demand still will dominate, but this is the sign that strong hands are starting to sell into the strength of the uptrend. Whereas on the side of the weak hands, this is an extreme point of excitement. This is where the weak hands are actually making some money in the latest parts of the uptrend. And as they're making this money, they're increasing their size, they are buying more, and that allows liquidity to increase again. And that allows the big composite operator types to start selling into the strengths of the weak hands. As the weak hands go through the trading range, they still see some short-term value for this position, which they can fuse, and they interpret this as a long-term value for them. And they come into the position at the correct points, at the support levels of the trading range, and also at the incorrect points, where let's say we have some kind of breakout character on the upthrust event, and that leads to the failure, the price returning to the trading range. Well, whatever weak hands are doing in the distributional area is always going to be counteracted by the strong hands selling into that weak hands activity. And that's what's going to produce kind of like this first strong uptrend, then stop in action, then loss of momentum, but still looking bullish, and then rounding up where now supply is starting to increase and the downward result is starting to increase as well. And then acceleration to the downside into the sign of weakness, and then inability to rally, and then final capitulation. So again, it's a process. Change takes time. And we need to understand how this process of change unfolds. And again, we're using our understanding of the Wyckoff concepts of how accumulation distribution happens, and we're using our understanding also of the timing based on the phase analysis of what should come first, what should follow that first initial change of behavior, and so on and so forth. As we go through the price cycle and we talk about behaviors, all right, so strong hands versus the weak hands, this is a much more appropriate term when we identifying and idealizing the behavior of the specific hands. So let's say the strong hands in the price cycle are going to behave as such. They will be buyers, contrarian buyers, at the point of the extreme fear, and that would form their accumulation area. Another segment of institutional buyers will be buying on the way up when the trend is starting to emerge. Those are going to be our institutional trend followers. So this is CO, this is institutional trend followers, and they will be buying on the way up to a certain point in the uptrend. Once they have loaded up, they're going to become inactive. And this period of inactivity could coincide with a couple of things. The volume signature, which is the long-term volume signature, might diminish. And also, we're going to see the weak hands participation is going to increase, which will bring us to more of the speculative phase of the uptrend. Again, something that we will study later on. Into this increased weak hands participation, strong institutional hands will start selling, and then they will start selling on the way down as they are capitulating as well. So different institutions will do different things. The CEO will be selling into the strength, the institutional trend followers, which is, by the way, could be your hedge fund, could be your pension fund, could be your insurance company, could be your bank, investment bank, and so on and so forth, mutual funds. They're going to sell in different places, and that's what's going to produce the structure. The weak hands behaving completely opposite in the mirror image of what institutions are doing. Composite operator, CO, Shandu, is either a composite operator or a composite man, so strong hands. The weak hands are going to be selling by capitulating into the low of their accumulation area. They will be selling now as the price rallies in the trading range, because now they're thinking that there's going to be a continuation to the downside. Then they will be emotionally exhausted. They will be out and become inactive. And they will be buying on the way up in the latest part of the uptrend. And they will also be buyers in the distributional area in the short-term value spots, which of course will fail at some point, and they will repeat this cycle over and over again. It's very important to recognize that weak hands will be profitable in some parts of the uptrend. And I think that all of us should recognize that we've been weak hands, and on a lot of occasions we will be weak hands where we are participating in that speculative phase, and that's what keeps us in the game. Because if we would be consistently losing, we would never participate in this game. But because the market gives us areas where by being a weak hand, we're still producing some money, that brings us back. So for my interaction with students, it's extremely important for me to change students' perspective of where they actually buying, and that all of the trades, you have to look at them, especially in your post-trade analysis, from the point of view of the whole larger price cycle, because contextualization of your trades is extremely important. And again, we'll talk about this later on. Okay, so here is an example of strong hands behavior. How do we recognize this on the chart? So we would be thinking that, let's say in the area where Steve Jobs came back and institutions got excited about his coming back, you will see some buying on the way down, and that will be shown to us in the volume spike signatures. That also will be shown to us in the price that starts reacting to the upside in a different type of way than before. And then because this is a long-term chart, we will recognize that a lot of buying by institutions will happen on the way up. Market activity, market itself, could derail the accumulation process sometimes. And this is what we see in 2000, in 2001, 2 and 3, where a secular bear market has developed. We also could see this in the most recent COVID price action as well. But then once accumulation is completed again through the consolidation, we're seeing how demand is starting to emerge, and they are still buying on the way up. This whole wave in Apple was buying by institutions on the way up. Why, you might ask? Well, look at the volume signature. Is this the volume signature that you could attribute to weak hands? Unlikely. It's just too much. It's only that the institutions could buy in billions of shares. And what do they do next? Institutional time horizon is usually very long, so they keep it. And as they keep it, the volume signature starts to go down because they don't present these shares to the market. And as the volume signature goes down, we would say about the CO that now CO becomes inactive. And therefore, even though the price is going up, the volume signature is not confirming institutional participation in terms of aggressive buying and aggressive selling. The same happens on the lower time frame. So here we are looking at the weekly chart of Apple. And again, this is where approximately where Steve Jobs comes back. So look at this volume spike, look at this volume spike, this volume right here, and this volume. So all of this is the contrarian CO buying with the new information that comes into them, and with the anticipation that the company will change the culture, the company will develop the new product line, which is going to be long-term oriented. That's going to create the new cash revenue, which is going to be stable because all of the products are going to be introduced, subsequently, and so on and so forth. So just based on that analysis, contrarian institutions are starting to buy, and then what happens? Other institutions, which we call institutional trend followers, are going to start buying as well. And we're seeing this from the volume signature. The volume signature is increasing. What does the price do? The upward result is increasing. So therefore, we know that the bias right now is to the upside. So any type of consolidations, we will be trading in the relationship to the established background, or the established context, or the established bias. If it's to the upside, then we will be looking for the areas of the reaccumulation stepping stone trading ranges with phases C and phases D, where we would be considering those phases as the timing for us to initiate the position and play those positions either long-term or maybe swing trades. So for instance, these would be swing trades, and this would be a long-term trade. And then once we go into distributional structures, this is where different type of traders are going to behave differently as well, either scaling out, getting out completely if you're a swing trader, or placing the stop losses in such way for the long-term trader that would at least assure that the catastrophic stop loss would not negate our gains here. And the price cycle just continues. Accumulation, markup, distribution, markdown, accumulation again. And it happens on much, much smaller time frames. So here is a 2-hour chart where we see the same type of behavior. As the price goes down and we're in the climactic run into the selling climax low, we see how the weak hands are giving up their position, and at the same time, there is a presence of demand from strong hands. They are starting to accumulate the shares as the price still goes down. Then we go into the trading range after the change of behavior, and we still see some buying where the price drops on the gap, but yet the volume signature spikes up, identifying for us emergence of the demand, which does what? The price after this comes back above the support, so that's a bullish price action, then consolidates and then breaks out on the increased volume signature, which is again confirmatory signs by the price and volume actions of the bullish reversal. And that's what we are going for. This is what we want to capture. And then once the background is established, again, we will be looking for the areas of the reaccumulation, specifically phases C as the timing. We would want to decipher the volume signature and price action of those as well, and start establishing the positions during those phases C and D on the way out. And then distributional character of the end of the uptrend are going to be associated with what? With selling into the strength. They already selling here into the uptrend, even though it starts, it continues, but the momentum of the uptrend is significantly diminishing relative to what we've seen before. And those type of characteristical changes in the price and volume behaviors we're going to be studying in WTC 1, WTC 2 courses, and I will give you, exact way of how to analyze the chart to pick those changes. And not only we're going to look at the changes in the texture, in the way of how the price and volume behaves, but we also will be looking at the structural changes, where we have, let's say, an element of an upthrust that fails back below the support. And this would identify for us the change of behavior and would suggest some kind of points of entry or points of exit, depending on where we are in the position. But the main message of this chart is obviously the time frame, right? So the price cycles are fractal; they exist in different multiple time frames, and we should recognize those price cycles basically everywhere. Let's talk about market participants and their trades. Hold on a second, guys. As I've stated, we are not necessarily calling strong hands composite operator. We are recognizing that there are different types of institutions that participate in the marketplace. The CO types we're calling institutional contrarian investors. So Warren Buffett is a really great example of that. Any type of big money management companies like PIMCO or BlackRock, or any type of big companies like Warren Buffett company and so on and so forth, those are definitely value seekers. So those are more appropriately called the composite operator. But the composite operator also a heuristic that combines other institutional types that are on the correct side of the price cycle. So institutional trend followers are going to be in that camp of the CO. Professional traders are going to be in that camp as well. But they all have different traits and different needs and therefore different behaviors. If the contrarian investor is all about the value with the huge size and with the time horizon, which is from secular to cyclical type of trades, holding on to trades for decades or for the duration of the business cycle, they are looking for a long-term value. They are looking for the short-term liquidity because they need a sizable position, and they only could create sizable position when there is some kind of capitulation that produces that liquidity. And they're also looking for the contrarian sentiment because at the contrarian spots, it's much easier to establish a meaningful position without moving the price in the direction of your bias. Now, their limitations are very significant. They are too big. They are looking for low turnover, meaning that their preference for the portfolio turnover is to be extremely low, and their clients are judging them based on the low turnover. And another limitation that they have is the tax implications, which is less and less relevant with later developments in the tax code, but they definitely would like to stay on the lower bracket of the capital gains. So tax implications is very important to them. Their edge is the time horizon itself. So when we talk about the market being uncertain, my understanding of the uncertainty of the market is that on any given day, on any given bar, whether this is a 1 minute bar or a tick bar or let's say an hourly bar, anything can happen. Any type of institution could come in, sell or buy, and that could produce an unexpected move. So this is the uncertainty of the market. Plus, any type of catalyst that are coming in that we are not expecting, like, who was expecting COVID-19 as a major long-term event, those are really hard to predict, let's say a year before it happens. It's just almost impossible, right? You only will see it when it comes. But when you look at the long time horizon, when you look at the business cycle, when you look at the major long-term cycles of expansion and contraction of the economy, you are gaining an edge there. And all of those contrarian and trend followers, institutional investors, they are most definitely having the time horizon as their big edge. They look at the long-term trends and they obviously have a very, very deep knowledge of the market. They imply that they employ the best talent on the street. They have been developing this knowledge and the method and the models for quite some time. So relative to, let's say, retail investor, they are having a very, very huge edge there. They are visible on the charts, though, with the extreme volume signature just because of their big size. They are visible at the points of the liquidity. They are visible on the absolute and relative trends, and relative trends is a great representation of where institutions reside. And they are also visible in the long-term volume signature. So we'll talk about this, and I'll show you all of those points as we start going through the charts. Institutional trend following is all about growth. So they need to be precise with their timing. They need to come in at the emergence of the trend. They need to get out at the first signs of the distributional activity. They are relatively big in size, and I would start be thinking like about the pension funds, insurance companies, investment banks, mutual funds, hedge funds, some of the registered investment advisors as well. Their time horizons is more related to the business cycle itself or parts of that, so therefore more cyclical behavior. They're looking for the emergence of the trend, break of the trend, long-term value, and short-term liquidity. Their limitations is the performance matrix, because usually these are going to be performance driven type of institutions, hedge funds. You need to perform, and you not only need to produce the money, make money, but you also need to outperform the market itself. So therefore, assets under management is also going to be extremely important. Low turnover as the requirement by a lot of the institutional clients is also going to be very important, and tax implications as well. Their edge is the same as the contrarian investors, the time horizon itself, the long-term trends, and the deep knowledge of the market. They are visible on the absolute and relative trends, long-term volume signature, and with the momentum buying and selling, where the volume signature starts to increase and we see the expansion of the price action itself. Professional traders are all about the momentum and mean reversion. Those are going to be medium to small size, daily swing or intraday. Those are either going to be professional traders that work for institutional trend followers or contrarian investors, or they trade on their own, but they are on the correct side of the price cycle. They will be looking for short-term overbought, oversold conditions and short-term momentum. Their limitations is that they are making too many trades, and therefore their commission is high, although this is not relevant anymore. I should probably take this out. Their limitation also going to be a short-term taxation and lower size, but their edge is always going to be quickness. They could get in and out of the position literally within the day or within a short period of time. They're going to be visible on the charts with their momentum buying and selling signatures, short-term volumes, short-term liquidity, and short-term swings. Those are going to be either proprietary traders, retail traders, or registered investment advisors. Retail traders, and majority of us are retail traders, majority of us are going to be all about the momentum. Very few of us will be long-term oriented traders. Usually in the classroom, we have the majority of students that are swing traders, whether you are a short-term swing trader or a long-term swing trader, one or another in that camp. And then on the edges as outliers, we're going to have intraday traders, and we're going to have long-term campaign traders. And we actually, talk about all of the time frames, so it doesn't really matter what time frame you trade, what asset you trade, whether those are cryptos or stocks or futures. The principles are going to be the same. There's going to be some variations, but the principles are going to still stay the same. The size for the retail traders is definitely small. Daily swing to the intraday. Breakouts models are very popular, and points of excitement where something is very popular, like on the social media, easily identifiable as the trend in the retail market participation, and those points of excitement will lead to a specific selection, like meme trades recently or cryptos just in general. The retail traders are going to be extremely sentiment driven with the lower knowledge and lower skill, and hopefully we can correct that and we can bring a lot of knowledge and skill building to you guys. And their edge is going to be always quick knit and different type of rules that you could change, and you could create really quickly different type of models. They are not as visible on the chart just because of their size, but we could identify the places of the institutional inactivity where retail activity will be obviously much more visible. And I'll show you where we are with that. And it's us, traders that don't necessarily have billions of dollars to trade, but we definitely could develop the size relative to the retail community itself. All right, so what's next? We are coming back to the price cycle, and now that we understand the market participants, let's quickly go through this chart and let's identify what those different weak hands and strong hands and trend followers are doing. So as I stated, in phase A of the accumulation, the weak hands are selling, the value buyers or the CO is buying on the liquidity, and the trend followers, which is the institutional hedge funds, pension funds, insurance companies, and so on and so forth, they are staying still inactive. Then as we go into the emergence of the trend, the weak hands become inactive. The value buyers are still buying, but now they are buying on the way up, and trend followers are buying. That's why during this sign of strength and during the change of behavior, we have the increase in the volume signature, and we have the increase in the result itself. Then as we get out of the accumulation, there could be some profit taken by value buyers, and trend followers will use this as an opportunity of the liquidity to buy more. They don't mind buying in the early stages of the consolidation because they are not necessarily technically driven. They are more, value or kind of like the opportunity driven. And when the opportunity of the liquidity arises in the bias that has been established and they like, it's in line with their models, they're going to be biased even in the early stages of the trading range. And weak hands might be buying here as well. So that usually produces some kind of pause in the uptrend. And this pause is our reaccumulation trading range, which concludes again with weak hands becoming inactive, value buyers buying only at the point of the value at the bottom, and then the trend followers are buying on the way out. And this process repeats again until we come to a distributional structure. And during the distributional structure, weak hands are buying again, value buyers are selling, trend followers could be buying in the early stages of the trading range, but they will be sellers once they see that the absolute and relative trends are starting to deteriorate. So therefore, the stop information and kind of like the rounding top information that is being formed. And as the price starts to go down, weak hands will be buying what they perceive value. Value buyers, so the CO, will be out completely and they will just not participate in this type of trends. And trend followers are going to be inactive after they have sold and after they have distributed the stocks. The trend followers later on could become sellers, short sellers, that is. So they will be opportunistically trading to the downside. And these are the behaviors of this, three groups: the weak hands, and then the strong hands, which are value buyers and trend followers in the price cycle. Okay, let's look at the examples and let's see if we could identify those contrarian investors, trend followers, and also weak hands. So here we're seeing that Apple, this is a daily chart, is in some kind of stepping stone reaccumulation trading ranges, one above another. And we see that every time we have a reaction in the initial trading range, we see how the volume signature jumps out, right? It spikes. So what does it mean? It means that there is an increase in the participation by institutions at this point. So then the next logical question is, what does this participation bring in terms of the result, in terms of the price action? And we see that the price does not commit below the support, or if it does commit, it only commits temporarily and then the price recovers really quickly. So therefore, from this action by the price and volume, we are concluding that there is some buying that is happening. And that brings us to the higher level, and the next reaccumulation trading range forms. And the price and volume action is kind of the same. Every time the price reacts, we see the volume spikes, and we see that every time there is some kind of buying at the bottom of the trading range, at the support level, in the zone which we will call a value zone. Again, this is a confirmation of buying. As the price starts to get out of the trading range, we see the increase in the volume signature. So what is that? Those are the momentum trend followers that are accumulating on the way up. And as they accumulate, let's say if somebody is buying right here, they're still profitable as the price goes up. So they're going to be using that momentum, and they're going to be using that established trend character to get into the position and to stay in this position until certain distributional elements are going to come. And those institutional distributional trades are going to be visible on the chart first as the selling into the strength of the trend. And you could see that from the volume signature. These are early but very recognizable distributional elements that still suggest that we could have some kind of continuation, but that continuation could be on the diminished velocity, diminished momentum character of the demand. And then once supply comes in a much more aggressive way, this is where you're going to produce a change of behavior. And this is where institutional contrarian investors are not only selling into the strength, but their selling starts to produce a change of behavior and the price goes down. And with the change of behavior, we are basically going to say, that's it, we are done. And now from the uptrending environment, we are going to go into some kind of trading range environment. Again, some contrarian selling into the new highs, less so than before. And then on the way down, this is where institutional trend followers are capitulating, and they are also establishing short positions. So with that, look at the volume signature, how it increases and how supply is increasing, and how the downward result is increasing as well as the price goes down. So with that, we know that not only trend followers are capitulating, they also might be establishing short positions, and that's why the whole structure changes. And now we are in a different environment. Instead of the uptrend, Now we are in the downtrend. And this goes on and on. Stop in action, they start buying. Oversold condition, they are buying. Another low, they are buying again. And with that, the price doesn't go significantly lower, and it starts showing the change of behaviors, and then the trend followers come in, and the whole cycle starts to repeat. And it's important for us to understand at any point of the price cycle, who is doing what, how is it going to look on the chart, how are we interpreting the volume and price action, and hopefully in this very simplistic way of how I'm showing it to you on different schematics and charts, you guys are getting the idea of what exactly we will be studying during this semester. Okay, and we have come to the last slide. This is the homework. So again, we have different participants for this session. We have the students who already signed up. So for you, this is a mandatory assignment. You're gonna receive the access information within the next 2 or 3 hours, where on the class page you will be able to get the video, get the slides, these slides that we went through today. You also will be able to download this article. I want you to print it out or put it on your iPads, iPhones, and read it. And then in the next class, we're going to build on that. By the way, right now, for those of you who are thinking about, taking the class, this is a really good time to ask me any questions. So, write it down in the questions window. For those of you who are considering whether I should be taking these classes or not, I think that if after this session, the whole concept of the institutional participation in the price cycle and identification of different market participants on the chart itself appeals to you, then you should most definitely go for that. We also call this course a foundational course. It doesn't really matter whether you trade with the indicators or just using the price action. You definitely need to understand the fundamentals, and by fundamentals, I don't mean the fundamentals as like the earnings and the revenue of the company, but the foundation of how to read the chart. It's extremely important, as I obviously have come into contact with thousands of traders students. I see how all of us could use this knowledge and the skill development in chart reading. In a lot of cases, there is something missing in the knowledge or the skill is not built correctly, and then you are making the wrongful conclusions, deductions about what you're seeing on the chart. So I think it's very appealing to finally get it under your belt and to figure out, how do I analyze the chart correctly? And Wyckoff method allows us to do that. It contextualizes a lot of the price action into specific structures. It also contextualizes the market participants' behaviors into the visualization based on the volume and price signatures. And obviously, I mean, we've spent a lot of time on the research and development of this material. So we have gone through many examples of the trading ranges and trends, whether it's an uptrend or a downtrend, in order for us to give you this material at this high level where, a lot of the students into the second and third months, they basically stating to us, I see the market differently. I understand the structure of the market now and what's unfolding. And then we build on that, a much deeper understanding of how the bias could be defined in the trading range, where the bias could be defined in the trading range, and how for us to time that and how to trade it. So I think quite a valuable material. I myself, have been the student of Wyckoff methodology for quite some time, for 25 years now. And this is my primary methodology, whether, this is for my RA account, personal account, whether this is for my speculative personal account, this is for whether this is for my hedge fund account. I'm a hedge fund manager, so I manage money. And it's a useful, extremely useful tool, even if you use other technical analysis tools. So consider that. Now let's go to some of the questions. Will the classes be available on YouTube? So this particular class, the first session, will be available on YouTube within the next 2 or 3 hours. And we will send out an email link to this particular class. You could revisit this, make notes if you'd like. Now, for the classes, we have password protected pages on our website for our students, so you will have the access to those pages tonight. And this is where we store all of our material. Next question. On the WTC1 course, do we prepare a trading plan? From Thomas. Yes. In the last couple of sessions, I will give you a Wyckoff trading plan pro forma, and that pro forma will have to be individualized by you. I'm going to give you kind of like the necessary steps in the trading plan development, and I would suggest where I would go, and I will show you like what I'm doing, and then you take that and you develop this. So yeah, in that regard, we have that. We have more advanced classes that talk about the trading plan development, back testing, and also the development of the process itself. So that comes, at a much more advanced level, and there's no reason to talk about this today. Next question from Imai, hopefully pronouncing the name correctly. I'm currently trading. If I would take the class, would you recommend stopping until I finish the course, or should I stay in my positions and trade and learn together? I would not recommend stopping trading if you're trading, successfully, or even if you're trading unsuccessfully, but you're controlling your risk. There is no need to stop the trading unless you want to. But during the duration of the course, you're going to come to realization of the new material. You're going to build the new skills, and you're going to start incorporating those in your trading. So as long as you control the risk and you're not like plunging, you're not destroying your equity, my suggestion is just to keep going and start gradually incorporating our Wyckoff concepts into your current trading. Michael, I signed up for this not knowing how many segments there were. Will I have access to all further webinars or just this single one? Michael, you will have the access as a signed up student to every video, every slide, and every homework for this particular course. So absolutely, tonight you will have that. Next question from Thomas. Are we able to trade actively during WTC1, or should we complete the course first before going into the market? Again, same type of question. If you're currently trading, I would suggest, continue doing so with the correct risk parameters. If you're not trading and you start going through the classes and you start seeing the patterns that we discuss in the current market, I would suggest that you go into more of the paper trading, forward simulation. That is very useful, or you trade with the limited amount of money. And that's very useful for the beginners, intermediate traders, just to kind of like get used to this methodology, because there are a lot of concepts you have to like think those through and incorporate them at the very unconscious level. So it just takes time. Is the current Wyckoff Associates the same legal entity as the original Wyckoff Associates from Jerry. No, it's not. Wyckoff Associates ceased to exist, but the body of knowledge was preserved through the Stock Market Institute, and we have a really good relationship with the current president, Todd Butterfield. Thanks to him and the people before him, they have preserved the material that was directly connected to Wyckoff. Now, the way how we approach the methodologies could differ, and I always say that there is always a discussion on the internet, or are you a pure Wyckoфfian, meaning, do you actually teach the same way how Wyckoff have taught or not? Nobody is teaching. Even Bob Evans, who was the director printer, after Wyckoff, for Wyckoff, nobody teaches Wyckoff method the same way how Wyckoff taught it, because method evolves. We learn more and more, and we go beyond the knowledge of what was given to us by Wyckoff himself. And I think it's a great development. And I think the whole conversation about the purity of the methodology or the purity of teaching is highly overrated by people who would like to become, to stay relevant or become relevant in our community. And I think it's to the detriment of people who don't understand, or as the beginners, they come to us. So I really, really, really would suggest to those people to stop, producing those type of thoughts and just concentrate on the understanding and development of the method itself. But very interesting question. Okay, do you teach how to scan for potential trades? From Adrian. Not only do we teach how to scan, but we have our scan expert on Wyckoff structures, Johnny Scan, who produces the scanning specials. We have 3 scanning specials. Check those out in our on-demand portion of the website. And he is extremely good at writing the scan syntax on stockcharts.com for our Wyckoff structural concepts. And John presents those regularly in the Wednesday WMD class that I conduct with Bruce Frazier. And that class is all about the application of the methodology. That's another way. Check those out. Is there also individual coaching session? Christopher is asking. I personally no longer do the individual coaching sessions just because I conduct a lot of classes, and just running the business itself takes a lot of time. We kind of have grown our community to the point where we have to pay a lot of attention to our members on a daily basis, on the development of the communal features and so on and so forth. But in the future, we are planning to come back to individual coaching sessions at some point. So that's in the making. Alfredo is asking, if I take this course, then I have to take the second one. Is there a third? How soon after will the second course start? So you don't have to take the second or the third course. You could just take the first one, and that could be just that. But I definitely would suggest taking at least the second course, just because we're gonna present you with a lot of knowledge throughout these 15 sessions in the spring semester. And then you need to develop the skill how to see this knowledge on the chart. So therefore, WTC2, the practicum, is where we go into drills and exercises together. I'm right with you there, and we just talk it through. We just go through so many exercises and examples, and we go through different concepts. The third course is just on-demand courses that we have, and I would suggest our tape reading courses, which is basically a chart reading course, not the level 2 type of tape reading. This is for advanced students. There is a lot of great material there, And absolutely, if you're going to stay with us and be a part of our community, I would be pushing you towards that type of knowledge, because this is going to deepen your understanding as to how to read the chart correctly. Could you talk about your success as a trader using Wyckoff methodology from Thomas? Absolutely. Recently I just ran the examples of the hedge fund activity, that I'm involved with in the last 2 years. We started the hedge fund, and the first year was 2020, which was a really great year for us. We made on over 45% that year. For the duration of the 2 years, we were over 65%, I believe. This year, we underperformed the S&P, which so we are under 27% for sure. I still have to look at the last numbers for the last year, because they're still coming in from the accountant, so I don't have the exact number, but we definitely underperform. But I think that the main thing is just preservation of capital and making money. So outperforming the S&Ps or the peers is kind of like more secondary. And then in terms of the individual results, for my personal accounts, I mean, just depending on the account. So for instance, like my RA account just have a lot of long-term positions that are like multi-year positions, and my speculative account has a lot of like short-term intraday positions, short-term swing positions, and the results there varies, from year to year. I was more concentrating in the last 2 years on hedge fund trading, so less trading with personal accounts and so on and so forth. And I'm extremely open with all of the calls that I make and all of the trades that I make. I show it not only in classes to you guys, but I also show it on social media. And if you go to our Twitter at Wyckoff Analysis, check those out. I mean, like all of the calls that are good calls and bad calls, a lot of the trades that are good trades and bad trades are there. You could literally scroll down and see all of the analysis that either I publish or we published as a company. So we are trying to be as transparent as possible, and that transparency will increase with time even more. Can I sign up for the scanning class even though I have not completed WTC1 class? Again, from Thomas. Yes. Please go to our on-demand portion of the website, find those scanning classes. I would suggest, because there are 3 of those, take the first one, because there is a foundation, foundational knowledge right there, and start from there. Next question, is there also a Wyckoff forum where participants can share information with one another? We do have forums on our website. Unfortunately, the social media is kind of like overtaking the forums a little bit more than we would prefer. So I'd say that there is a conversation on Twitter from time to time. We also have a crypto Discord where there is a constant conversation about the methodology and how it applies to crypto trading, and the forums on the website. So those are the 3 major sources for our students to communicate. Could you reveal the name of the hedge fund? Unfortunately, I can't, because this is an alternative investment hedge fund for an insurance company, and it's still as a kind of like a trial project for them. So it's not necessarily your regular hedge fund, Thomas. But I could definitely show you, if not all of the trades, then the majority of the trades that we've done there. So, and you could see, how we traded those. All right, so this was the last question. With that, guys, thank you so much for being here. Again, if you would like to sign up for our course, go to wyckoffanalytics.com, find the WTC1 course part 1. Then tomorrow, don't forget that we have the open door as a free session at 3 p.m. Pacific for part 2, and kind of like, seeing what's going to become as the next step, I think is very important. So most definitely everybody's welcome. So go sign up. And if you can't even attend, just sign up to receive the link afterwards. With that, thank you so much, guys. Thank you for all of your questions. Thank you for your participation. Thank you for being here. Reach out to me at wyckoffAssociates@gmail.com. I will gladly, answer any additional questions that you have. Thomas, thank you for signing up. I am looking forward to working with you in this semester, and looking forward to working with everybody who already signed up, if you're a student of this class or if you plan on signing up. With that, thank you so much, guys, and until next Monday. Bye-bye.